Big metropolitan areas, Austin, Texas, Tampa, Orlando, these were once synonymous with runaway price appreciation, have seen much quicker inventory recovery than the national averages. This is helping for the balancing of our market. If you're in the Tampa and Orlando area, now's the time for you to focus. Whereas Denver, Dallas have returned to their exceeded pre-pandemic inventory levels. Ultimately, the Southeast is going to head in a very similar direction. Agents are going to do well to pay very close attention to the regional migration trends. If you are deep in the Southeast, you are going to see a lot of it as tax changes happen in the northeastern United States that are straining ownership and straining the taxation on their residents. They are going to move, and they're going to move fast. Plenty of opportunity for you to look at these graphics inside of even as simple as Zillow. Those types of charts are especially valuable in projecting growth of secondary markets as well. They can start listing and marketing efforts a little bit farther in advance and are going to help you be more prepared to represent the people, the flood of people that are coming in from higher priced areas. If I just pick on California and New York, I'm telling you, I'm banking 20% of all of the new buyers that we're going to deal with, domestic new buyers, are going to come from those areas. When you are dealing with areas that are just choked by political strife, taxation, they're going to move, and they're going to move fast, and this is going to be a great area for them to do that too. So what about the buyer and seller outlook in 2026? Predictions are showing a less frenetic competition, more listings to select from because the listings are sitting on the market a little longer. So you've got some negotiating clout with your buyers. This is going to help for better terms as the market begins to recover from some of those inventory shortfalls. Fannie Mae is saying that affordability is going to continue to be still out of reach for a lot of people out there until mortgage rates drop into the lower fives. For sellers, the outlook is improving, but mixed by the market. So the sellers are in a low supply market. They're still going to be able to command strong prices, but those balanced like we are here in Florida, most of Florida, it's going to be important on you focusing on staging, setting the strategic list price, offering concessions like rate buy downs. Remember, a rate buy down has the long-term strategy for a new buyer as opposed to a price drop. So as more sellers are returning to the market because they're motivated by life events and the impatience of sitting on their house for another year like they did last year, rising equity is going to help them in this decision boat. Real estate professionals need to expect that the conditions are going to tilt, and they're going to be ready for prepared buyers and realistic sellers. So if you are that beacon of truth that we're asking you to be, if you have been using all of your analytics, if you have been using all of your selling strategies that we've been talking about, you're going to be well prepared, and your golden neighborhood is going to be well educated into the swing that's about to continue. Investors, however, are going to have to contend with a market that gives mixed signals. On one hand, demand for rental property is going to remain super strong, but more specifically, the fast-growing and affordability-oriented metros is where that's going to happen. The build-to-rent sector continues to expand with institutional capital. Private investors showing interest in this category are going to struggle. You're going up against big capital companies, and they're trying to buy as many properties for rent as possible. So when the market finally swings completely and the interest rates finally drop to support, they can join the seller's strategy and flood the market with properties. So headwinds in the form of rising insurance premiums, rising property taxes, tighter lending policies, these are going to compress some of these margins. The data certainly points to softening of multifamily development, especially in your metros. Though it continues a fairly healthy pace, that's going to change, and it's going to change dramatically. Rent to own and co-living are innovative models. They're going to gain a little bit of traction so that they can help with some of the incentives like the builders are supporting. This is going to give sellers and major capital investors opportunities to get people into the house long enough that they can eventually sell the properties to them. Do we believe that mortgage rates are going to fall below 6% in 2026? If you're going strictly by the data gathered through Fannie Mae and even looking at the NAR predictions, rates are probably going to continue to stabilize, but maybe dip into the lower 5% by late in this year, beginning of next year. Rates less than 5% probably aren't going to happen for yet another 12 to 18 months. But when that happens, certainly we'll be in full market swing by that point, and we can begin the refinance process that everybody typically looks to follow after they go ahead and buy now while the homes are cheaper. For the majority of buyers, now is going to be better than what you have dealt with in the last 2 years. Increased inventory, rate stability, proven control and options at the negotiating table is going to help squelch some of that affordability issue that you've been fighting for the last year. As far as crash is concerned, let's go ahead and throw that out the front door finally. A widespread crash is improbable. Appreciation of residential property values are going to come to a slower halt, but persistent shortages in the overwhelming majority of markets and the supporting values are going to allow for the corrections in pricing, and that's going to continue to happen. People are still continuing to overprice their homes because they missed that swing several years ago, and they think they're going to be able to capitalize on it now, winning on both fronts, on a higher price and on more equity. And simply, they're going to lose if they continue to price that way. So, what does that mean if I slam it all together in one big statement for you? The housing market for this coming year is poised for stability and a lot more drive towards stability and improvement than we have seen in prior years. Buyers are going to experience fewer bidding wars, which is going to give them more negotiating power at the table. And in certain markets, while seller inventory is going to be a little shaky, they should be able to gain some great pricing opportunities and even better concession at the closing table. This is where investors are going to be able to balance those higher insurance premiums and the regional policy changes with some strong rental demand and improving build to rent opportunities. Keep your approach in sync with the latest predictions. Watch your numbers, understand the buyer's momentum, what they're waiting on, and when those green lights hit, be ready to pump on the gas. You're going to be poised to thrive in whatever the year brings as long as you are following the numbers. Have a great day, everybody. We hope this information is helping you be a better professional, more informed seller, and a more professional buyer at the negotiating table. Have a great day. Do good business, and we'll see you all again very soon.